Hello, welcome back everyone. We're going to continue with Chapter 9, Purchasing, Financing, and Insuring a House. In this video, we're going to go over homeowners insurance. Let's get started. There are two reasons to have homeowners insurance. First, if you take out a mortgage, the mortgage company usually requires sufficient insurance so that if something does happen to your house, their secure property is insured. The second reason is that your home is typically your greatest asset. So you definitely want to protect it through an insurance. There are three important elements to watch out for in a homeowner's insurance policy. The first is the type of coverage. This means what are covered. So dwelling and structures, this is the structure of the home. Second is loss of use. So this is when your house is not available, whether or not they will pay for your renting a hotel or another apartment. Third is personal property. This includes everything inside the house, such as furniture, appliances, your personal belongings. If you have something very expensive, you can have a personal property floater. So for example, a wedding ring, jewelry, painting. The fourth type of coverage is personal liability. So this is to protect someone suing you if they get hurt on your property. So that's liability against you. There are other coverage as well that is unique to your personal circumstances. So this first four, journaling, loss of use, personal property, and liability, are typical in terms of types of coverage. The second element is the type of risk. They are called perils. Perils are what causes the damage. So named peril policy, very interesting term. It means that you only cover dangers that are listed in the policy. If something that caused the damage but is not listed in the policy, that will not be covered. An open peril policy means that they will cover all damages except those that's listed in the policy. So anything that will not be covered is listed. So those are the exclusions are listed. The named peril only cover the ones that are listed. So they're exact opposite. Open peril policies are more common because it's easier to know what is not covered than it is to name all the things that you want to cover. The last element is actual cash value versus replacement cost. Most mortgage company will require replacement cost because the actual cash value may not be sufficient for you to replace the lost item. So if you buy a home that is that the cash value, for example, your house was built 20 years ago, obviously it will cost a lot more to rebuild that house today. Let's take a look at the types of risk that is covered. So we said that named perils policy, this will typically list the things that will be covered. So a basic named risk policy will cover damages caused by these things. And then you can have a board one. You'll include all of these dangers plus weight of ice, freezing or plumbing, falling object. You may think that, oh, this covers everything, but let's take an example. If you have a pet and your cat push over a fish tank and the fish tank's water damaged the ceiling of the first floor, that is not listed here. There are a lot of things that we may not think of that happen. Insurance adjusters makes the best guess because they have all kinds of stories of what they see. An open policy, unlike named policy, it covers all perils except the exclusion. So the most common exclusions are earthquake, flood, nuclear accidents, war. So be aware what is excluded. Anything that's not excluded, the policy will cover. So this is much easier to work with. Because flood and earthquakes they are acts of God, and they are very difficult to insure. Usually these policies are very expensive. You can buy specific flood policy and earthquake policies. Particularly flood policies, you can purchase them through the National Flood Insurance Program. This is a federal government program. If you live in a high-risk area, you should definitely get that. Homeowners policies are standardized. There are several forms, and they increase in the level of coverage. The first one, the basic form, has the lease element. This covers just the structure, so it doesn't include any personal property, and the cash value rather than replacement value against basic named perils. This is usually not sufficient, and very few people uses this one. Form 2 expands the coverage in the broad category. Form 3 is an open peril policy. And tenant form this is actually the renter's policy. Renter's insurance is called tenant's form, but it's actually the renter's policy. We already talked about that in the very beginning. Comprehensive form 5, this is the most common. It includes dwelling, other structure, personal property, replacement cost, loss of use, and personal liability. So for most of you, so the Form 4 is for renter, and Form 5, H05, this is the most common one. So for most of us, this is the policy that we'll use. 1, 2, and 3 are very special cases. It's not adequate for most of us. If you live in a condo, you'll use Form 6. This protects personal property and anything but not the basic structure. So remember, in a condo, you do not own the common structure and the common property. So if you own a single family home or a multi-unit home, you use comprehensive Form 5. And if you own a condo, you use Form 6. What affects your insurance premium? Here are some important factors. First of all is the amount and the type of coverage. An important determining factor is the value of the house. So a more expensive house will have a higher value. The neighborhood also have a factor. If it has a high crime rate or has a high fire risk, that will typically increase the premium. The amount of deductible, remember that deductible is the amount that you pay before the insurance pay off the damages. So if you have a $5,000 deductible, that means you pay for the first $5,000 of any damages before the insurance company pay. The location, and also protective devices or services. So some of this is very interesting. Protective devices include burglary alarm, smoke detectors, fire extinguisher. For location, if you live near a fire hydrant, that can give you a discount. Other discount that is oftentimes useful is a multi-policy discount. For example, if you have both your home and your auto insurance from the same company, you may get a discount. A lot of them also offer discount to groups. So if you belong to the same alumni group or other interest group, you may get a discount. The key to homeowners insurance is to shop and compare the policy. It is worth doing the legwork. If you find a better offer on your homeowner's policy from a new insurance company, you can go back and negotiate with the company that you currently already have the auto discount, for example, so that you can keep the multi-policy discount and still get a good deal. How do you make the most of your homeowner's policy? If you do suffer damages to your house, or I should say before you suffer any damages to your house, you should have an up-to-date home inventory. If you don't know what you have in the house, you cannot claim damages. A home inventory is simply a listing of everything that you own. You can list items room by room and keep track of major purchases. If that may be too much of a process, at the minimum, take a picture of every room in your house. So that can be your inventory. So you can go back if necessary to count all the things that in each room. If you have damages to your house, you should contact the insurance company right away. An adjuster will come and estimate the damages. At that point in time, you can present them your home inventory to let them know what you have in the house. The insurance company may give you an estimate on how much damages they will pay. You may want to get an independent estimate. You may, for example, if there are structural damages and you need a contractor to do the repair work, you may want to get your own estimate. If the estimate by the insurance company is too low and is insufficient to do the work to repair your home back to the original or a livable condition, you may need to appeal so that you can get the repair that you need done. In addition to protecting your home, you may also want to consider buying additional personal liability. So this is on top of and separate from your homeowners insurance policy. It's called an umbrella personal liability policy. The purpose of this policy is to supplement your other insurance policy for additional personal liability coverage. So remember that your insurance has a limit. So however much coverage you purchase, let's say you have $500,000 in personal liability and someone gets hurt either by your car or because they're on your property and they sue you for $1 million. If they are successful, the insurance will pay $500,000. You are still liable, that for the liability part, you are still liable to pay the remaining $500,000. And that will come from your savings. So if you have if you have wealth or you have savings, you may want to have that to protect your wealth. Before you can buy an umbrella policy, you have to have an existing auto or homeowners insurance policy first. This policy will pay after those other insurance have paid. When you have built sufficient wealth, you may consider adding an umbrella personal liability policy. This concludes the video here as well as chapter 9. I'll see you back here in chapter 10 when we talk about investing. See you soon.